Hello guys, we're starting with the third lesson of economics, which is money and credit. And it's a very simple lesson. There are not too many complex theories or topics from this lesson. It's actually very simple. So let's start. Let's start understanding by certain examples like what is the basic thing used as a medium of exchange when you're going to purchase a product in the market, or if you need to purchase a product and when you do not have money in hand, what do you do? So the answers for these two questions would be money and credit. So what is money? Money is used to buy basic goods and pay for services. Sometimes and sometimes we do not have money in our hands, and what do we do during those particular times? We pay later. And what is this called? This is called credit. Money is mostly used in our day-to-day transactions, and money is also used as a medium of exchange, and people generally prefer receiving payments in money because it can be used to buy literally anything and everything. Now, before the introduction of money as a medium of exchange, how were goods exchanged? So goods were basically exchanged with a system called barter system, and this system was sometimes complex. Let me help you understand what am I trying to say here. So for example, I grow as a farmer sugarcane, and I have taken a sugarcane to the market nearby, and I would like to purchase cotton, and I would go to the cotton seller, right? And I would try to exchange the sugarcane that I have with the cotton seller. But what if the cotton seller do not want sugarcane? Then I would have to look for a person where the third person is having some other good that the cotton seller has, so that the exchange can happen between all three of us. Now what if the third person also do not have the goods that I and this second person want? So this keeps expanding like anything, like a chain reaction, and this would become an extremely a difficult transaction for us to continue with. So barter system is a system in which double coincidence of wants work, and if double coincidence of wants work, only then the system would be successful. If not, it's a failure. For example, what is double coincidence of wants? For example, I want a product that a person, so and so person, has, and he needs a product that I have. So here the coincidence is happening twice, from my side and his side. So, and barter system would be successful only if double coincidence of wants is happening. Now, and the problem here is sometimes complicated, like I explained, and money eliminates that problem. Money eliminates that issue of double coincidence of wants. So money is a very convenient medium of exchange. Now the next thing is, at present, what is being used as a form of currency? Right now we have paper currency and coins, and back then, what was used? Back then grains were used for medium of as medium of exchange, and also cattle was also used as a medium of exchange. And after that, coins made out of gold, coins made out of silver, coins made out of copper were being used. They were also very popular. Now what is actually currency? The today's currency that we are talking of has its own importance, has its own relevance, but it itself does not have any intrinsic value, which means, what do you do with the currency notes? Would you eat, or would you do something else with that? No, you cannot do anything with that. That's what I mean by having no intrinsic value. For suppose, the other thing that we're talking of is grains, cattle and all. What would you do with grains? You would cook food, right? Or what would you do with cattle? You would extract milk from that, and you would be using it for drinking purposes, correct? But what would you do with the currency notes? You cannot eat, you cannot drink that. Or what would you do with the currency notes? It has no intrinsic value of its own. It's literally useless if it is not used for medium of exchange, right? So that's the point. Another thing is, the currency, it also has a lot of value. Reason is, all these currency notes that we are using for circulation in our country or any other country for that matter, they're generally authorized by the governments, they're authorized by the reserve banks. Then and mostly these currency notes are issued by reserve banks of each country. And the law makes that the rupee should be the legal tender, and nobody can refuse payment in currencies. Generally, sometime we have this issue, like for example, there's a 10 rupee coin, and these auto drivers or shopkeepers, they refuse to take this 10 rupee coin, saying it has stopped to become legal tender, but that's not the case. And if at all anybody is refusing to accept the payment of a 10 rupee coin or something like that, he is bound to be prosecuted. So reason is, it's a legal tender, nobody can refuse it, nobody should refuse it. Actually, it's backed by the government of India. Now, the moving on, this is about the modern form of currency, or the day-to-day day-to-day circulation, currency notes, coins. But there's also another form of currency, that is the digital form of currency. Digital form of currency is generally can be seen with deposits, bank deposits, like savings deposits, fixed deposit, or term deposits. There are multiple types of deposits under that, recurring deposits for that matter. And all these deposits have their own things, like for example, with a savings deposit or a demand deposit, different names, the same. Anytime I can deposit money into my bank account, and anytime I can withdraw without anybody asking me not to do that. Nobody can do that. On my demand, banks are supposed to provide me my money through ATMs, through check facility, through debit cards, etc., etc., etc. This is called demand deposit. The other is time deposit or term deposit, which is generally called as fixed deposit as well. Now, what happens in a fixed deposit is, I deposit money, let's say 1 lakh or 10 lakhs today, and then there would be a term, that is the maturity date. For example, only after 5 years I'd be able to withdraw this money. This is called time deposit or term deposit. For facilities like this, for fixed deposit, banks generally do not provide ATM card or debit card, or check facility would also not be there, right? So that's how this is. But for savings deposit or term deposit, we have ATM, we have check, we have various other facilities. That's the difference. Now, how would bank function if they keep taking all these deposits on our interest? The reason is, with banks, what happens is, for all the deposits that we put into the bank, they also give us an interest rate, let's say 4% or 5% or 3%, right, or 6% for that matter, for fixed deposit. For all these deposits, for example, let's say I deposit 100 rupees, bank is supposed to give me 104 rupees. That 4 rupees is the interest rate. Now, how would bank actually benefit with this? It's giving me extra money. The simple answer is, banks do not just take deposits, they also lend loans. In the sense, for example, I go to a bank to borrow money from the bank. What happens is, whenever I'm closing my loan, I'm supposed to pay an interest to the bank, right? Even in the case of deposit, bank is paying the depositor the interest rate, whereas in the case of a loan, bank is accepting the interest paid by the customer, which is higher than the interest rate actually paid by the bank to the depositor. So that margin is actually the profit. Like for example, I go to a bank, deposit my 100 rupees, bank gives me 104 rupees. Another person goes to the bank, takes loan of 100 rupees, he is supposed to pay 108 rupees or 109 rupees. So what is the margin here? The 5 rupees or 4 rupees is bank's profit. So that's how banks function. Now, on any given day, banks do not actually use much of its cash. Hardly 5% or 6% of all the entire deposits are generally used. Rarely depositors come to withdraw their money. So what happens is banks, with all their deposits, start using that money as loans. So that there are so many businesses that require loans. The major portion of deposits is actually used to give loans by the banks. Another thing is bank actually acts as intermediaries between people with surplus money and people who actually need money, right, in terms of loan. So that's how this works. Now there are different issues with different types of loans. Let's first understand how does a loan work. A loan work with something called the terms of credit. Any a borrower, when he's going to a loan, when he's going to a bank to borrow money in terms of a loan, he is supposed to agree with certain things called the terms of credit. Terms of credit is nothing but what is the interest rate that I am agreeing to pay to the bank. Then what am I putting as a security for this loan that I'm taking from the bank? Let's say my property documents or gold, or what am I putting in the bank to take this loan? That's called collateral. Then what's the documentation that I'm attesting? For example, Aadhaar card, my address proof, my ID proof. What else am I giving to the bank? And what are the things that I'm agreeing with the bank? Like, for example, when would I be repaying this loan, in what number of years, and in what mode? Is it through cash, is it by check, or how am I doing this? All these comes under terms of credit. Now, let's look at different credit scenarios, like different types of loans. Let's say there's a person who's borrowing, money through a loan, and he's using it for manufacturing shoes. Now, he's taking credit for the sake of from the leather supplier and a trader, and he completes his work on time. So what happens? He earns profit and by selling the shoes. So this credit here has actually benefited his business. The other scenario, there's a lady who takes a loan for her farming activities, but she fails to repay because the crop has actually failed. So what happens? She is forced to take another loan to repay the first loan. What if the next season also crop gets destroyed, by natural calamities or some other reason? She's forced to take another loan to repay the first two loans. So this is a problem, and this is called debt trap. Generally, people who are into farming activities, they're trapped into this situation called debt. Now, how do people arrange credit? There are various sources to arrange credit. There are banks, there are microfinance institutions, there are cooperative societies. These are all under the category of formal sector credit. Then there is this other category called informal sector credit, which is like friends, your neighbors, money lenders in the village, or village headmen, anybody from whom you can take a loan. All these come under informal sector of credit or borrowing. Now, in both these types, the various things change. Like, for example, the repayment time changes, the mode of repayment changes, the interest rate changes, and various other things change. Now, how does we'll try to understand about banks and informal sector credits later, but we'll first understand how does a loan functions from a cooperative society. First, what is a cooperative society? Cooperative society uh, is a system in which there are multiple people involved here. There's a person with land, there's a person with machines, there's a person with all the necessary labor, there's a person with funds. All these people come together to start an economic activity. Now a branch of this would be a cooperative bank. Now they also participate in lending activity. How do they do it? For example, there are let's say 2300 members from whom this society is accepting deposits, and using these deposits by showing it as collateral to a bank, this society can actually borrow a much higher loan. So what happens? Using that loan, it will again fund the depositors. So what happens here? This is a circle in which it keeps continuing. Meanwhile, they'll also be making profits through the interest rates difference between lending and borrowing. Now, the first thing that I was talking of is formal sector credit. Uh, like a while ago, what's a formal sector credit? Any borrowing that happens through an institute which is following the rules and regulations of RBI, it's called formal sector credit. Generally, banks, cooperative societies, microfinance institutions, all of them come into this category. Now, generally, they charge a very low interest compared to an informal sector. Now, informal sector, like I said, money lenders, friends, relatives, neighbors, village headmen, all of these could be into the category of informal sector lending. And generally, they're not supervised by anybody like RBI. And they charge high rates of interest. And there's a problem of, goons coming at your house uh, to get their money back if you've not repaid the loan on time. So you might be thrown out of the house, or whatever the property that is inside your house, like mobile property, might be, flying in the air. Anything can happen with these. And recently, from the last 20 to 30 years, what is RBI doing? RBI is actually promoting formal sector credit. Reason? When formal sector loans are expanding, money comes back into the economy. It keeps circulating in the economy. And like, for example, I have taken loan from a bank. What happens here? I would be repaying that money to the bank. That's first thing, with an interest rate. Second thing. Third thing, the loan that I would be taking, I would be using it to start a business. So what is happening with that business? I am making profits. Also, when I start a business, I would be employing people. So I would be paying salaries to them. So whatever the profits that I'm getting, I would be purchasing a house, let's say, or I would be purchasing groceries, or I would be putting my child into a school. So what is happening? For which I have to make payments. So what is happening here? Money keeps circulating in the economy. That's one reason why RBI is promoting formal sector loans. Also, the statistics are there for you to see. 51% of credit in rural India in the year 2019 has actually come from commercial banks, and cooperatives provided 10%, whereas money lenders provided 23%. Right? So 23% is a lot. Next, let's now understand another concept called self-help groups. What's a self-help group? With regards to economic activity, generally self-help groups are groups formed by women from rural areas. Even in cities also they can be formed, but generally prevalent in rural India. Self-help groups are 15 to 20, 25 members uh, who pull up their money, and they would start some economic activity, let's say pickle manufacturing, papad manufacturing. And so this is their economic activity. That's how they make profits. And the money generally is pooled up. Let's say to start a business of worth 2 lakhs, 15 to 20 members they'd be sharing or pooling up 10,000 each, or 20,000 each, or 15,000 each, for whatever that they require. So this is actually a successful model in India right now. Why? Even banks are actually interested to lend them money without too much trouble. Reason is, let's say this self-help group requires a loan of 5 lakhs, right? A person from one of the self-help group has actually taken a loan of 5 lakhs, and the chances of her defaulting the loan are very less. Second thing, even if she defaults on that particular loan of 5 lakhs, the other members of the self-help group take the responsibility to repay. So banks are getting their money back either ways. So this is about self-help groups. Another thing is how a simple concept actually revolutionized the rural India, which is Grameen Bank. Grameen Bank is a concept which was started in Bangladesh. It was started by someone called Muhammad Yunus, for which he was also given Nobel Prize in economics. Until a few days ago, he was the interim prime minister of Bangladesh. And this Grameen Bank concept actually started somewhere around 1970, with 9 million members in around 81,000 villages across Bangladesh. By 2018, these are the numbers. And most of these borrowers are poor, they're from downtrodden sections. Generally, the loans would be, for starting, a vegetable selling activity in the early morning, and by the end of the day, they would be having their money to repay back to the bank. That's how this activity started, and now it's a flourishing business. And India also adopted this concept of Grameen banks just to help these people from rural areas with their small business activities like vegetable vendorship, or fruit selling activity, or some other stall activity wherein they're selling samosas, pakodas, etc., etc., etc. And this is also, a risk free activity from the bank side, and it is also profitable for all these, borrowers. So both the parties are actually benefiting here. So these are all the activities these are all the topics from this particular lesson, money and credit. So that's all from this. Thank you.